If you're buying a property for a limited company, but instead of buying the property, you're actually buying the company that owns it, then you're going to need a share purchase agreement. Now, this isn't your typical conveyancing process, and if you get it wrong, it can cost you far more than just the legal fees. A big thank you to Maria Magnussen at Market Financial Solutions for educating me on this and providing some fantastic material that helped shape today's video. Hi, I'm Dan, a buy-to-let mortgage specialist, and in this video, I'm going to explain exactly what a share purchase agreement is, when you'd use one, and the major risks and benefits UK landlords need to be aware of. In this video, I'll be breaking share purchases and share purchase agreements down to answer the 4 key questions. What is a share purchase and how does it work? Are there any risks involved? When is a share purchase ideal? How can specialist finance assist with share purchases? Before I start, there will be a lot of mention about tax. I'm no tax expert. I'm here to give you the ideas. It's then strongly recommended that you speak with a qualified tax advisor who can provide tailored advice to your individual circumstances. So please do not act solely just from watching this video. So what is a share purchase agreement, also known as an SPA? A share purchase is a way to buy property portfolios or assets in a slightly different way than usual. Instead of directly purchasing properties, you buy the shares of a company that owns those properties. This means you're acquiring the company that holds the assets, along with any liability the companies have. A share purchase agreement is a contract that sets out the terms and conditions relating to the sale and purchase of a company's shares. In the property investment market, SPAs may be used in tandem with a special purpose vehicle. So what is a special purpose vehicle, I hear you ask? A special purpose vehicle is a company that's created for a very specific purpose. The SPV is considered a legally distinct entity and has its own assets and liabilities. While dependent on individual or entity-specific circumstances, purchasing properties held by SPVs have the potential to provide financial advantages, such as avoiding higher stamp duty rates. An SPA may be used to purchase the shares of an SPV. One benefit of a share purchase is that following completion of the share purchase, the titles of the property held within the SPV do not need to change. The benefits of buying an existing SPV for an SPA are potential tax savings, streamlined ownership, and flexibility for large portfolios. When an individual buys an additional residential property in England, they pay the higher rate of stamp duty land tax on the property's full value, which for high value residential properties can be up to 17%. With a share purchase of a company incorporated in England that holds assets, the transaction is subject to a stamp duty of 0.5%. Yes, 0.5%. By buying the shares of a company, you also acquire the structure and systems it uses to manage the property. This includes tenancy agreements, leases, and management systems, making it easier to keep operations running smoothly. It is important to note that you also inherit the tax liability when purchasing via a share purchase. So clients should understand the accounts of the SPV they are purchasing, so due diligence is a must. For those acquiring multiple properties, a share purchase agreement can simplify the process by keeping the portfolio within a single company intact. You can hold multiple assets under one company. This is sometimes attractive for portfolio landlords, as they may be looking to hand this over to a management company, for example, or just do it in-house. Since you're buying the company and not just the property, you need to investigate its full history. This includes, but not limited to, debts, tax obligations, ongoing contracts, and liabilities. The share purchase agreement outlines all terms of the deals, including warranties, which are promises about the company's condition, indemnities, which is protection against future claims, and the price. Once the agreement is signed, you own the shares and take over the company along with all its assets, like the properties and the liabilities. So who arranges the share purchase agreement? Typically, this will be drafted through your legal team and negotiated with the seller's solicitors. This can increase the deal timeline and add in additional complications, so it's important that all parties allocate time and potentially extra funds for legal costs for this. There may also be tax implications. which may require additional guidance from accountants or financial planners. So will a lender ask for additional documents when purchasing using a share purchase agreement? They typically treat these purchases the same as if it was a property purchase when you're purchasing through an SPV. The property will remain the security and they will conduct the process with the same due diligence. So when is a share purchase ideal? Share purchases are commonly suited for high-value property purchases or large portfolios due to the potential tax savings and operational efficiencies. This method is growing in popularity in the UK as buyers recognise the financial advantages that it can offer. If structured correctly, a share purchase can be a strategic way to maximise value while acquiring valuable assets. It is important that borrowers seek tax advice to ensure that this is the right approach to them. Thanks again to Maria Magnussen at Market Financial Solutions for the information and for helping make this video possible. If you've not come across MFS before, they're a specialist lender that aims to support borrowers and buy-to-let investors who might struggle to fit into the tick-the-box criteria of mainstream banks. So if you've got a more complex deal, short time frame, or unique setup, they're worth speaking to. As always, I create straight-talking videos for UK landlords covering buy-to-let, bridging loans, and smart property finance strategies. If you're serious about growing a portfolio, YouTube's picked a video out for you here. Give that one a watch next. Thanks for watching, and I'll see you next week.